Nvidia reports earnings tomorrow after the close, and it walks in on a 7-day losing streak. That's the longest run of down days it has had since 2022. Every headline you'll read about that says the same thing. Nerves, traders getting cautious before the biggest print of the year. And that explanation is comfortable, and it is almost certainly incomplete, and here's how you know. 7 days is a week. What happened to Nvidia has been happening all year. Nvidia is up about 12% in 2026. The Philadelphia Semiconductor Index, the chip index that Nvidia is the single largest member of, is up about 61%. So the company everyone calls the center of the artificial intelligence trade has spent this entire year losing to the industry it supposedly leads. That is not a week of nerves. That is a repricing. And today, I want to show you what the market has quietly decided Nvidia now is, why that changes what its earnings are even worth, and the one thing tomorrow night can actually settle. Let's be fair to the consensus first, because it isn't dumb. Here's the version you'll hear everywhere this week. Nvidia is about to report a quarter with roughly $92 billion of revenue. That's up something like 97% from the same quarter a year ago. The company itself guided to $91 billion, plus or minus 2%, back in May, so it's on track to clear its own number. Options traders are pricing a move of nearly 6% in either direction on the print. On a company worth around $5.26 trillion, that's about $282 billion of market value swinging on one press release. So of course people are cautious going in. And here's the part that makes the nerves story genuinely credible. Nvidia's stock has fallen after earnings in 6 of the last 8 quarters. 4 of those in a row. So there's a real pattern where the number is great and the stock goes down anyway, and traders have learned it. That is a coherent story. It explains 7 days. It just doesn't explain 8 months. So here is the number that reframes everything. Year to date, Nvidia is up about 12%. The Philadelphia Semiconductor Index is up about 61%. Sit with that for a second because it's genuinely strange. This is the same trade. It is the same theme, the same customers, the same build-out, the same story about artificial intelligence eating the world. The market has paid the index roughly 5 times better than it has paid the company that is the index's largest single component and its most famous name. Whatever the market is doing here, it is not doubting artificial intelligence. It is buying artificial intelligence enthusiastically. It's just decided that Nvidia specifically is worth less of it than the group. That's a very specific verdict, and it deserves a very specific explanation. Quick backstory, because this only lands if you know what the business really is. Nvidia designs the chips that train and run artificial intelligence models. It doesn't own the factories that make them. It designs, and it sells, at an extraordinary margin, and that's the whole magic of the thing. Historically, people described Nvidia as the arms dealer of the artificial intelligence war. Everyone's fighting, and it doesn't matter who wins, because they all buy their weapons from the same shop. That is a beautiful business. It's beautiful because it's neutral. The arms dealer takes no side and carries no risk. If one buyer goes bankrupt, another buyer takes their slot in the queue, because the queue is longer than the supply. That is exactly the business the market paid an enormous multiple for through 2023, 2024, 2025. Now hold that description in your head, because it has quietly stopped being accurate. Here's the turn. Over roughly the last year, Nvidia stopped only selling chips and started funding the people who buy them. In January, it put another $2 billion into CoreWeave, a company that rents out Nvidia-powered computing, and that was already carrying a heavy debt load. In February, an original $100 billion commitment to OpenAI collapsed, and Nvidia instead took a $30 billion equity stake in OpenAI's $110 billion funding round. In March, $2 billion into Nebius, and it backed a $2 billion raise for thinking machines. And then the big one. Nvidia has partnered with Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR to build financing platforms designed to mobilize more than $500 billion for artificial intelligence infrastructure. Reporting puts the wider deal footprint around $750 billion. All of it is public. All of it is disclosed. None of it is a scandal. But look at the shape of it. 2 numbers hold the whole shape. $30 billion, the equity stake Nvidia took in OpenAI's $110 billion round, in a company whose entire purpose is to consume enormous quantities of Nvidia hardware. And $500 billion plus, the scale of artificial intelligence infrastructure financing Nvidia is helping to mobilize alongside the largest private capital firms on Earth, aimed at building data centers that will be filled with Nvidia chips. Each of these deals has the same skeleton. Nvidia writes a check or backstops somebody else's debt, and the recipient turns around and spends it on Nvidia silicon or Nvidia-powered cloud capacity. Now, none of that is illegal, none of it is hidden, and vendor financing is a completely ordinary thing in capital equipment, but it does something to the accounts that is not ordinary at all. This is the kicker, and it's simpler than it sounds. When you sell picks and shovels to gold miners, your revenue and the miner's solvency are 2 separate problems. Their problem is finding gold. Your problem is making shovels. But the moment you start lending the miners the money to buy your shovels, those 2 problems fuse into one. Your revenue is now partly your own capital coming back to you with your logo on it, and your risk isn't just, will they order again? It's, will they survive long enough to pay? That is not an arms dealer anymore. That's a bank that also happens to manufacture, and banks, famously, do not get paid the same multiple as arms dealers. So here's the mechanism, and this is the part that actually explains the 12 versus 61. A stock price is not really a bet on revenue. It's a bet on the quality and durability of that revenue. Two companies can earn the identical dollar and be worth wildly different amounts because one of those dollars is safe and repeatable and the other one is lent, cyclical, and contingent. What the market appears to be doing to Nvidia this year is not marking down how much money it will make. Revenue is nearly doubling. It's marking down how much that money is worth because some of it now arrives with credit risk attached to it. And that is why the rest of the chip index can rip 61% while Nvidia lags. The other names sell into the boom without financing it. They get the volume without the counterparty exposure. Nvidia gets both. So the group gets re-rated upward on demand, and Nvidia gets re-rated downward on quality at the exact same time. Those two things look contradictory in a headline. In a spreadsheet, they are the same sentence. Which brings us to Wednesday night. And here's why the earnings print is a much smaller event than it's being sold as. Everyone is watching the revenue line. 92 billion or thereabouts, up 97%. But the revenue line cannot answer the question the stock is actually asking. If Nvidia clears 92 billion, that tells you demand is enormous. It does not tell you how much of that demand Nvidia funded itself. Quality question doesn't live in the headline number. It lives further down, in receivables, in the investment and equity stake lines, in the customer concentration disclosure, in whatever the company chooses to say about how much of its pipeline is attached to entities it has capital in. So the honest way to watch tomorrow is this. If the stock rips on a big revenue beat, that is the old arms dealer story reasserting itself. If revenue is enormous and the stock still sells off for a fifth straight quarter, then the market is telling you plainly that it has stopped valuing the top line the way it used to, and it will keep telling you that until the composition of the revenue changes. All right, time to argue against myself properly, because there are 4 real problems with everything I just said. 1, that 61% index gain is partly a rebasing story. Memory and equipment makers were crushed far harder in 2025, so they are climbing off a much lower floor. A wide index gain is not automatic proof that Nvidia is losing anything. 2. A stock that trades sideways while revenue nearly doubles is multiple compression. After 3 years of extraordinary expansion, that might just be healthy. Boring is not the same as broken. 3. The sell side flatly disagrees with the price action. The consensus analyst rating is still buy, and the average price target sits near $309, roughly 49% above where the stock trades, with estimates running from $250 up to $500. So the tape is bearish and the analysts are not. I can't tell you with certainty which of those is the informed one. And 4, vendor financing is genuinely normal in capital equipment. Boeing did it. General Electric did it. Cisco did it. Calling it circular is a characterization, not a finding. So take this as a lens, not a verdict, and know that it can be knocked over in about 30 hours. Here's the read, stated so it can be proven wrong. If this repricing is really about revenue quality rather than nerves, then over the next 2 reported quarters, Nvidia's receivables and its investment and equity stake lines should grow faster than its revenue does. That is the fingerprint of a company financing its own demand, and it's visible in the filings, not in the headlines. And if revenue keeps compounding while those lines stay flat, then this whole read is wrong. The market really was just nervous, and the arms dealer story survives intact. That's the test. 2 quarters, public filings, no interpretation required. Most valuable company in the world is up 12% in a year when its own industry is up 61%. That's not a story about artificial intelligence being doubted. It's a story about what happens to a franchise when the seller starts financing the buyer. So, is Nvidia still the arms dealer, or is it quietly become the bank? Tell me what you think below. This is research and education, not investment advice. I'm Frankie, and this has been the Asymmetric Signal. One Contra Ryan read a day, subscribe.